With the best all-inclusive vacation deals to Mexico and the Caribbean, booking your getaway with Cheap Caribbean Vacations means you have more freedom to do your deal. Whether you enjoy snorkeling, endless margaritas, and more, or simply soak up the sun and sand in a tropical paradise, Cheap Caribbean Vacations has your deal for that. Plan and book the exact getaway you want at exactly the right price for you by using our exclusive Budget Beach Finder, or find a featured all-inclusive package to Jamaica and do your deal at cheapcaribbean.com.
Good afternoon. Doing it live here at 4 o'clock. Right down to business here. A news-driven hour on 790 KBC. Mottek On Money. Live on the air 790. Streaming live online worldwide at kbc.com. And your on-demand Mottek On Money podcast at kbc.com, Apple, iTunes, and all your favorite podcast platforms. Well, TGIF heading into the St. Paddy's Day holiday weekend. We also have the LA Marathon coming up on Sunday. So if you know how that goes, you'll want to pay attention to those maps on Sunday. The stock market pulling back today. In fact, we've ended the week lower once again. For the week, the Dow slipping slightly, just down 0.1%. The S&P 500 also down 0.1%. And the Nasdaq down 0.7%. The Dow down for the third week in a row, while both the S&P 500 each booked back-to-back weekly losses. Today, the Dow gave back 191 points. The S&P 500 down 33, and the Nasdaq dropped 155 points. Driving the action today, we'll take a look at that coming up here. We saw the mega cap companies known as the Magnificent Seven, the big tech companies in recent months. Looks like the shine has faded on those, as we've been talking about, except maybe NVIDIA, but even that one's pulled back a bit. Several so-called big tech stocks, the Magnificent Seven, shares of Microsoft, for example, down 2%. Amazon down 2.5%. Google, Alphabet, parent company, down 1%. Meta shares down nearly 2%. And Apple shares down 0.22%. On the economy today, we heard from the New York Fed's Empire State Business Conditions Index, a gauge of manufacturing activity back east, pulling back in March to a negative reading. Industrial output inching higher in the month of February following a decline in January. And reading from the closely watched survey of consumer confidence, falling slightly in early March from a 32-month high. This has gas prices been rising lately. We'll take a closer look at that. We see the price of oil moving higher this week. In fact, it stands at the highest we've seen since last November. New high point for the year today. The yield in the 10-year note has been moving up lately, and right now stands at 4.30%. That's the one that impacts the fixed-rate mortgage rates out there. Former Trump White House official Peter Navarro appealing to the Supreme Court today to allow him to stay out of prison as he appeals his contempt of Congress conviction. Peter Navarro, a familiar name here in Southern California, former UC Irvine business professor before he joined the Trump administration, is due to report to a federal prison next week after an appeals court ruled that his appeal was not likely to overturn his conviction for refusing to cooperate with a congressional investigation into the January 6, 2021 attack on the U.S. Capitol. He's facing a 4-month prison sentence for defying the January 6 Select Committee's subpoena. It turns out California comes in dead last for job growth in the United States. I'll talk about that eye-popping report with Jonathan Lansner, business columnist for the Southern California News Group, coming up later this hour. Are we in for even higher taxes? Well, according to President Biden in the State of the Union speech, we're looking at a $5.5 trillion tax hike and the highest tax burden in U.S. history on the table now, $7.3 trillion budget blueprint. The Office of Management and Budget estimates now the national debt would surge to $45.1 trillion, or nearly 106% of the nation's gross domestic product by the year 2034 under the plan. Keeping track of all that, taxpayer advocate Grover Norquist, president of Americans for Tax Reform, will be joining us later this hour. But first, on Your Money, the markets and the economy, with us live now, investment expert Brian Perry, chief investment strategist and portfolio manager at Mint Asset Management at mintassetmanagement.com, author of the 25% Cash Machine. Brian, thanks very much for taking the call. Stocks pulling back, and by the way, crypto's also pulling back. They don't just go straight up, as it turns out. Looks like a Bitcoin hovering at around just below 69K here after hitting close to 74,000. Give us your view of things this week.
Well, you're right, Frank. We did see a market that took a pause here, and it was a healthy pause from what I can envision, going forward. Stock market closed this quarterly options expiration day, today, on a downbeat note, with the AD line, advanced decline line, not that bad, not really that bad. It was just I would call it normal consolidation here for many leading stocks. The energy sector has had a good week, as you noted here. So there's been some what they call sector mean reversion here, where what was working is now taking a break, and then what wasn't working is starting to see investor interest here. It's a good rotation. It's healthy, and I think that we still will see as we go into the end of the quarter here, the window dressing of big cap tech will again bear the torch higher. It's a buy the dip type of opportunity here, and I think that because we had a big an earnings guide missed by Adobe, which is a leading software stock, it really was the culprit for a lot of the big caps today pulling back here. But actually, advisors of investors, that I talk to and all the wealth managers, they're still relatively conservatively positioned here in this market here. And for the most part, the measures of investor leverage, which are you can look at the $6.1 trillion in record cash in the sideline, and lower margin debt, which is still below the July 23 levels. That tells me that there's still a lot of gunpowder on the sideline here for this market to push higher here as we come into the first quarter earnings season, which will start the second week of April in earnest. Now, the big story going into next week is going to be the NVIDIA GTC conference here in San Jose, and that's going to happen between Monday and Wednesday. And the keynote speaker there is the CEO of NVIDIA, and he's going to basically bring a lot of really talk about the major developments by NVIDIA and what's going on there, and all the developments and the latest in artificial intelligence and their new product offerings and all of that. So I think it's a big moment for the market, and it's going to be one where I think that you're going to see the CEO of NVIDIA really put on a show. And so it's going to be the most packed conference in recent history. And the only guy that can pack a room more than he at this point in time is probably Taylor Swift. And he's that popular. This company is driving the market and the whole AI revolution, and he's going to talk about just how big it's going to be and the impact that's currently having on all these industries here. So I think there's a lot going on here. I think that with that happening, you look for a catalyst in the market here to kind of stem the bleeding from the last 3 days, and I think that's going to be it.
You're live with Brian Perry, investment expert at Mint Asset Management, and we see NVIDIA stock, by the way, down just about $1 today, by the way, at $878.36. They're calling that one the Magnificent One at this point. We've been getting away from the Magnificent Seven label lately because they haven't been so magnificent, and looks like NVIDIA might even overshadow the Fed next week, which is the other significant event next week, right? The Federal Reserve policymakers will be holding a 2-day policy-setting meeting on Tuesday and Wednesday, and we'll get a decision on interest rates and a statement on the economy, and then a full-blown news conference again from Fed Chairman Jerome Powell when that meeting wraps up at 11 o'clock our time on Wednesday. What do you think the Fed is going to do and say next week?
Well, it's pretty well baked in the cake that they're not going to do anything with rates. They're going to hold tight here. And with the recent inflation data here, the PPI and CPI numbers that came out this past week, pushes out the likelihood of a Fed rate cut to June, maybe even July, possibly further out. There's a lot of data between now and then that'll either bleed into the inflation story from the standpoint of it's sticky, it can't pull back. It's still the shelter index is still very, very, very tough right now, and that's keeping inflation elevated here. Energy now is pushing higher, so that's an issue. But I think zooming out toward later this year, we are seeing inflation grind lower on an annual basis. So I think that the Fed is still geared up to maybe cut twice during the course of the second half of the year, and the market does try to look 6 to 9 months out and anticipate that. So this is why we're starting to see things like the small caps are starting to behave better here because the leverage that lower interest rates can bring to the small cap market is just huge. So this is where I think the Fed's going to talk about how healthy the labor market is, how the economy's in good footing here, and that they still need to drive this inflation rate down toward 2%, that's a tall order right now with the inflation running at close to 3.5% to 4%. I think that's not as powerful of an event taking place as this NVIDIA concert on the front end of the week.
Very interesting. And one of the other significant comments made this week, it should be noted, Treasury Secretary Janet Yellen, the former Fed chair, said she regrets describing inflation as transitory when she described it that way several years ago. That's the term several Fed and Biden administration officials have used to describe the inflation situation, which was initially thought to be temporary, but as you noted, has turned out to be sticky, and we're all feeling the impact here to this day. And it should also be noted that we're seeing government bond yields, Treasury yields, finishing mostly higher today, and the yield in the 10-year note, which I mentioned impacts the fixed rate mortgage rates, has seen its biggest weekly advance in almost 5 months. What about that part and its potential impact on the economy as well as mortgage rates and overall impact at this point?
Well, it certainly should have an impact, Frank, even though we continue to see strong demand for most housing markets that are still out there. A lot of new developers, they're actually they're offering a discount on the mortgage rates if you buy a new house, through Lennar, Pulte, or DH Horton, and the big ones, so there's, they're buying down mortgages here where they can, mortgages are up around 7% there, but they'll help the buyers by maybe giving back 2 points on a mortgage. So there's a lot of, it's not a gimmick really, but it's a give back in order to continue to move volume there, because they don't want to have to slash their labor forces, or they have really good skilled labor and then have to try to rehire those same people, a year from now. So and they still want to be able to get volume onto the market, because there is definitely a national housing shortage that continues to fester. So this is where I think you're still going to see good houses sell right away. I'm just not seeing any real give back here where I'm in Virginia, and it's just tight, and it's really tight, and it's tight in most markets here where there's good jobs. And as long as the labor market's firm, and it is, then it's going to continue to be upward pressure on housing prices, or at least I don't see any relief in housing prices anytime soon, even with mortgage rates at where they're at.
Mm-hmm. We also watch cryptos closely, and Bitcoin has pulled back from its recent all-time high. It got as high as 73,798, and right now at around 68,900 or so. What about this move mostly lower on the cryptos this week?
Well, it came up so fast that now it's back down to where I think you're going to see 65,000 be kind of a support level here. We've got this the halving of the Bitcoin is taking place somewhere between April 18th and April 21st is what the estimates are, and so this is where you're going to have only half as many Bitcoins produced every 10 minutes that there are now. Right now, there's currently 12.5 Bitcoins produced every 10 minutes, and that's going to come down to 6.25. So that's the supply is going to be slower coming out, and it's just going to continue to be in deep demand here, especially with all these ETFs out there where you've got professional money now just wants at least a portion of this Bitcoin ride. And I think that's really where we're going to see the 65,000 hold as a support level here, and then we'll probably see Bitcoin continue to push higher. Again, my target's 80,000 between now and whenever, maybe by the end of the year, but it could happen considerably sooner.
At this point, Brian Perry, where are you putting money now and or taking it off the table?
Well, again, I think the small cap market here, the IWM is, that's the ETF for the Russell 2000. I think people ought to start looking at that here, because you just got a lot of combination of factors that are coming into play here that's going to be very supportive of the small cap rally in the second half of the year. So I think it's good to start planting your seeds now in that area. In terms of coming back into this, some of these big cap names have had they pulled way back here, like Dell Technologies. That's another AI play here in the equipment side here. CrowdStrike looks good. That's a big pullback here. IBM pulled back nicely here. Micron Technologies pulled back nice. Lyft, the counterpart to Uber, is breaking out to the upside here. Western Digital, is supplying hard disk drives here for NVIDIA components going forward and for hyperscalers here. So that was good. And on the travel side, Carnival Cruise, the cruise lines are showing strong demand here. And CCL looks like it wants to break higher here at $16. Looks like it may want to make a move to 20. And then Samsara, which is an AI-related logistics play, IoT, that ran up on big blowout numbers, ran up to 41. It's pulled back here to 35. Take a look at that. Coming off, I got a Petrobras this week because they're going into a lot of renewable energies, and they're slashing their big fat dividend, which has been so popular with investors here. So I'm out of that. I sold some CME Exchange here, Chicago Mercantile Exchange, and Zscaler. They kind of give soft guidance going forward here. So I would prefer CrowdStrike over Zscaler. And then MCOR, which is a construction engineering company here, which is vaulted higher here. It just took profits in that because it looks like it's just really overbought. And from that standpoint, I'm still waiting to buy gold on a pullback if we get one here. But it's holding up very well, Frank, and I think that breakout in gold is significant. People should, maybe buy a third and then look for to build a position here going forward in the gold market.
Very interesting. We have seen gold hit record highs recently. Let me take a look. It's hovering around 2,159.40. Silver at last check. Let's take a look at that silver price. Let me take a look here. Around $24 or so here at last check here. Yeah, around 24. So what about the other metals? Right now, of course, everybody piles in when all this stuff hits record highs. The case with gold and seen with Bitcoin, but silver has quietly been hovering right around 24 and change here. What about silver and the other lesser known or less publicized metals not getting as much attention nowadays?
Sure. Well, silver and copper, industrial metals here, and with China being still in a slow pace, silver has made a move here alongside gold. It's moved up nicely, about 10% here in the last week. Copper is starting to behave better as well here, but runs counter to the fact that the EV craze has started to slow a bit. So that was the big catalyst for copper here, but it's construction also. Copper is a big time construction component to the commercial and residential markets here. So that looks like that may want to hunt going forward here. So maybe take a look at big copper plays like Freeport McMoran and BH Billiton, BHP, and Rio Tinto, RIO. Those are the big three publicly traded copper plays out there. So they've been down, and if you think that we're going into the business cycle here where the Fed's going to be lowering interest rates here, then you want to start looking at some of these deep cyclicals here, because that should accelerate growth going forward here as construction picks up.
Silver, by the way, at 25 and change now. It has ticked higher this week, 25.41. And we see platinum, by the way, at 942 and change. It looks like it moved up today by about $6. So we're going to start keeping an eye on those as well. Any other thoughts about other commodities here? Oil hitting a new high for the year, for this year to date anyway, above $81 a barrel. Where do you see the price of oil going, and what about those oil names at this point?
Yeah, they've really had a nice week here, especially the refiners just really ripped higher. And but again, there's a lot of tension. This is sparked by a lot of tension over, it's picking up the volatility over in Ukraine and Russia, if you can believe it. It gets worse. But also in the Middle East here, the Red Sea attacks have just unabated, and there's just a general belief that the economy, the U.S. economy, is going to hold together, and that Europe's not going to fall into a recession as it first thought. Other than oil looks like it's going to hold 80 and then maybe go to 85, but I think at that point then you get a lot of dumping on the market by the OPEC plus nations there. So I expect that to be the case again. It always seems to be the case. And the natural gas just can't get out of its own way there because we've had a pretty temperate winter here and over in Europe there. So natty gas is at $1.66, and that at some point that'll be a buy, but just it's an avoid for the time being.
All right. Well, we wish everyone more wearing of the green from a dollar standpoint, certainly, as we get set for St. Paddy's Day here this weekend. Brian Perry, Chief Investment Strategist and Portfolio Manager at Mint Asset Management, and author of the 25% Cash Machine. Brian, thanks again for taking the call here this afternoon. Wish you a great weekend.
You too, Frank. Thanks so much.
Thank you very much. And right out to the freeways now, 790 KABC. Folks, let's be honest. Sometimes we find ourselves or a loved one dealing with a massive injury caused by a terrible accident by no fault of our own. Sometimes it's simply being in the wrong place at the wrong time. We're all good at preparing for earthquakes and fires, but let's not forget to prepare in case we're involved in a major accident. It's critical to know who to call first. Clark Fielding became a lawyer to help you in a crisis. Fielding Law is focused on justice and resources for you because they understand how the system works and what to do in the most horrific situations. I always say to put the Fielding Law team in your phone under the word accident, so all you have to do is hit dial. Believe me, you will feel better having set this up for yourself and your family in advance. The number is 833-88-SHARK. Again, that's 833-88-SHARK. With the population exploding and increased vehicles on the freeways, be proactive. Prepare for the worst and expect the best. But if and when you do need help, call Clark Fielding and his team of sharks at 833-88-SHARK. Again, that's 833-88-SHARK, or go to clarkthesharklaw.com. Again, that's clarkthesharklaw.com. Mottek On Money continues here in 790 KBC. Good afternoon. Stocks pulling back today, still hovering near the record highs we hit recently, but Dow down for the third week in a row. The S&P 500 and NASDAQ down 2 weeks in a row now. The Dow down 191. We're back to 38,715. The S&P 500 down 37 at 5,118. And the NASDAQ down 155 at 15,973. The yield on the 10-year note up around 4.30%. Price of gold down $8.10 at $2,159.40 an ounce. Platinum at $942.40, and silver right now at $25.41. Mark Hulbert from MarketWatch noted actually a month ago in a column that gold and platinum are giving strong clues that stocks could gain 15% or more this year, noting that a little-known indicator with an impressive record, the gold to platinum ratio, is bullish for the U.S. stock market over the coming 12 months. Very interesting. The price of oil at the high point of 2024 here, hovering just above $81 an ounce. Bitcoin seeing a wild ride, hitting record highs recently of just shy of 74,000. Right now it's up about $50, back to 68,910. Ethereum up 90 at 3,717, and Doge at 16 cents. And now the latest news for you here in 790 KBC. Good afternoon. Mottek On Money continues here in 790 KBC. Are we in for even higher taxes, according to the president? Yep. In his State of the Union speech, we're looking at $5.5 trillion in tax hikes and the highest tax burden in U.S. history on the table now. The Office of Management and Budget, meanwhile, estimates the national debt would surge to $45.1 trillion, or nearly 106% of the nation's economy, basically the nation's gross domestic product, by the year 2034 under this plan. And by the way, he said it again. Under the plan, he said nobody earning less than $400,000 a year will pay an additional penny in federal taxes. Let's check on that statement as well. Keeping track of all this for you, he is your taxpayer advocate, Grover Norquist, the president of Americans for Tax Reform. Grover, thank you very much for taking the call here. I know your ears have perked up given that speech and the plan that's on the table here. Give us an update on what you're seeing here.
Well, Frank, President Biden wants higher taxes and more spending. And the speech was just one after another, higher taxes and more spending. He's out there saying we should take the corporate income tax, which right now is 21%. It used to be 35 before Trump and the Republicans took it down. When it was 35, we were higher than everyone in Europe. We were higher than Japan. We were higher than China. We were not competitive in the world. We took it down to 21. That makes us okay competitive. I kind of like Ireland, 12.5, better than 21. Yeah. But we were doing okay. What Biden has announced he would do is take our taxes up to 28% at the federal level, plus about 4% at the state level, so 32%, higher than China. China's at 15 for their key industries, 25 for others. So every American company and every worker in the United States trying to compete internationally with China would have Joe Biden and the Democrats stepping on their ankles saying, well, now you can run and see how fast you can go after we've burdened you with higher taxes than China has. And it's not just the corporate income tax. He also says we should take the tax which most damages new investment, capital gains tax, where people risk money they've saved all their lives and they put it at risk, hoping to make a good investment. And that's why traditionally we've had a lower capital gains tax to encourage Americans to invest in the future and for their retirement and to innovate and create more jobs in the United States. Biden has announced he thinks our corporate rate should be up at Jimmy Carter territories. This is a guy who doesn't remember what happened during Jimmy Carter's presidency, of over 44%. Where's China? Half that, 20%, less than half that. China will get people will invest in China because if you do well, you get to keep more of your money. How do you like that? The American government will steal more of your money when you invest it than communist China will. This is what Biden announces he wants to do. Good news is this doesn't happen if Biden loses or if the Republicans win the House or the Senate. So if you vote for a Democrat for the House, Senate, and Biden, you are voting to make America non-competitive with China, with Europe. And he can say that's not a tax on the American people, but the problem that Biden faces is Americans have figured out that when you tax a grocery store, the prices go up. When you tax a grocery store, wages at that grocery store go lower or at least slow down in terms of getting people ahead because there's only so much money a grocery store has. If the federal government comes in and takes $2,000 of it, that's money you can't use to hire people or to pay people more. Or if they take $20,000 or $200,000. So those taxes that he's putting on, most of them will fall on people who make nowhere near $400,000 a year. He just hopes that you don't put two and two together and realize that there is nobody named Mr. General Motors, that when you tax Mr. General Motors, you're taxing workers, you're taxing consumers, and you're messing with people's 401k and IRAs.
On the air live with Grover Norquist, America's leading taxpayer advocate, president of Americans for Tax Reform. I never thought we'd go back to the Jimmy Carter days. We do remember what happened. Remember when President Reagan came in and things turned around on inflation and interest rates, and then the voters had another choice in 1984 whether Walter Mondale or President Reagan should be in the president's office, and people couldn't vote for President Reagan fast enough back in 1984. Remember that?
Absolutely. And our friend Mr. Biden has created the inflation that Jimmy Carter created for the same reason: spending too much, slowing the economy, having too much in taxes, and damaging the growth of the economy. We've seen this before. This is not new. It's stupid, but it's old stupid. It's not new stupid.
Mm-hmm. And you mentioned Ireland. We got the St. Paddy's Day coming up here. In recent years, we saw some American companies move to Ireland. You mentioned that attractive. Haven't seen that so much lately, ever since the rates here came down. But now we might see an exodus back to Ireland pretty soon here.
One of the challenges with threatening people with tax increases is that companies will avoid building new factories in the United States or hiring new people here. They don't wait until Biden's actually passed the taxes. They start leaving or going somewhere else, investing somewhere else, the moment they smell that that's what the United States might do. So every time Biden goes up in the polls, you'll see decisions being made around the world to invest in countries other than the United States.
Anything else on your radar screen since you have a front row seat there in Washington?
Well, watch out for the IRS to get worse. They've now announced that they will go after people who use the tax cut, the Trump tax cut. If they don't think if they don't like what's in the Trump tax cut, so they say it doesn't have economic substance, and so they want to use a law that Biden put in that says the IRS can say, well, that's not the law. We don't like that law. We say that if you follow the law, you're cheating. Literally, if you follow the law, you're cheating because we don't like the law. They didn't repeal the law, by the way. They just announced that that's their new position. So it's going to get a little more difficult to guess what the law is. Thank you, Mr. Biden, and your tens of billions of dollars of IRS agents.
Here we are, already March 15th here. We got April 15th coming up before you know it. Anything else we need to know between now and our tax deadline day, which is coming up here Monday, April 15th, next month?
Well, if you were planning on leaving California and going to New York, don't. The New Yorkers have just decided, the state legislature, that they want to raise their top rates up closer to California's number. So they were afraid Californians might move to New York. Now they're raising that tax up, so that won't happen.
Isn't that something? Well, Grover, thanks for keeping track of all of this and helping all of us out. You are the guy that's watching out for us, the taxpayer advocate Grover Norquist, president of Americans for Tax Reform. Thank you very much, Grover. We wish you a happy St. Patrick's Day weekend. Thank you very much. And right now to the freeways now, 790 KBC. Mottek On Money continues here in 790 KBC, turning now to the Main Street economy. Turns out California comes in dead last for job growth in the United States. Let's bring in Jonathan Lansner now, business columnist for the Southern California News Group. Jonathan, thank you very much for taking the call here this afternoon.
My pleasure.
It's been a while since we've chatted behind live microphones, but this report certainly got our attention here. What's your reaction to this news here on job growth here in California?
Well, the first thing is it's hard to argue with job growth. I mean, that's good news. It's the fact that in what was a really good year for job growth in the rest of the nation, California at 1% or just slightly under 1% finished last. But, for people, whether you're a policymaker or a follower of the California economy for various reasons, it's certainly a moment to say, perhaps things aren't going as well as hoped. Last year was an interesting year in California's economy. One, obviously, we finished sort of replacing all the jobs that were lost during the commotion during the coronavirus emergency. Perhaps one of the other interesting things last year was the state was the hub of sort of the labor unrest. We had that lengthy Hollywood strike, which not only hurt job growth, but, has a lot of tentacles out to many other industries. And unlike other businesses where there's strikes, Hollywood doesn't restart the next day. So I think there's delays in getting projects re-going, and that may be hurting job growth too. And then the other thing that everyone's been talking about is what's next in the tech industry, which has certainly slowed down, and that's certainly another drag on California employment. So, the great question is was this just a one-year blip, or perhaps a period where California will underperform? Because whether you look over the past 10 years or 50 years that I looked, California has been one of the faster growing job creation states in the nation. So it's a little stunning to see us last, and the last time we were last was 1993, which was a whole different year. The California economy was very weak. One, the aerospace industry was starting its downward spiral for many reasons, including some major defense cuts. And two, we had a real estate bust in the early 90s that really slowed the economy down. So in 93, we were very weak and perhaps an otherwise decent U.S. economy. Last year, we were slow growing in a rather robust, surprisingly robust U.S. economy. So two different stories, but 2 years where we were at the bottom of the barrel.
Right, and remember those all those bases were closed back in those days, and now here we are back to the same looking numbers back then. That's quite remarkable and noteworthy. And any hope of turning this around? Obviously, policymakers seem to be on a different path nowadays. How is this going to be turned around?
Well, the first thing is let's go to, I think Hollywood's taking a slow time. And Hollywood is a big business in this state. I expect them probably to be in full gear sometime at this year. The tech industry is the big question, where they clearly hired too many people during the pandemic era and made a lot of assumptions about how fast things would grow, and they're now pulling back. And I think that will continue. Another industry that is struggling a little lately, which was hot, was the warehouse industry, because we all extrapolated all the growth when we were all sitting at home and ordering everything with a couple of clicks on the computer. Shopping in person is back again, and that's not great for the warehouse business. I don't think that will change much too. So there's a lot of headwinds to the California economy. But again, overall, the U.S. economy obviously seems too strong because the Fed is finding too much inflation, and the interest rates are staying high, and interest rates are a problem in California for multiple reasons. One, it's an expensive place to do business, and interest rates are just another expense. And two, obviously, it hurts our real estate business, which is a big part of our economy. So it's still a lot of questions. I don't think that we're going to see any grand disaster this year. It just may be another year of economy, if that's a technical phrase.
I think it is, and even the LAEDC economic forecast was pretty anemic for this year, but all of last year we were talking about a recession which never came, and this year, what's the mood that you pick up at these conferences and among the movers and shakers that you talk to there in Orange County? What's the mood there at this point?
It's not hard to find someone who has a less than robust outlook for the economy this year or next. But again, as you aptly pointed out, people have been saying that for 2 or 3 years. And on the flip side, the economy seems to be, in other ways, very strong. And it may not feel like it. I know people are affected by layoffs, and certainly inflation's biting all our paychecks. But in some ways, some of those things are literally the evidence of how strong the economy is. So, like I said, I think California will be The rest of the economy may be surprised to a little bit better than and the whole thing is going to be watching and waiting for some signal from the Fed that the economy is cooled. But until you see that, I think it's just going to be more of this sort of relatively slow but upswinging economy.
Anything else in your latest article, which people can check out in the Southern California News Group? The headline is California ranks dead last for job growth in the U.S. Golden State bosses added workers at a 0.87% rate in 2023. It's in the Orange County Register today and throughout the Southern California News Group. Any other big takeaways you'd like to share with us here now?
Well, I mean, the other thing we've seen some sign of weakness is that the paychecks in California and in the nation are not growing as fast as they were. And also inflation is slowing down too. So those are positive signs. But, if we're to have that grand soft landing, this is probably what it feels like, is just sort of an economy that's gone from very hot to sort of mediocre, to use a word, and it beats the alternative of some sort of slippage, even in slippage into a recession. So I think in some ways it's be careful what you wish for, and this is what we're getting right now, is sort of a sideways moving economy that is not, headline grabbing on either end of the equation.
All right, and the good news is it's St. Patrick's Day holiday weekend, so some places will get an economic boost there, right, Jonathan?
Holidays, we've seen to make holidays far bigger than they once were, and good for the marketing people who have done that, and good for the businesses that can cash in on whichever holiday it is, because yesterday was Pi Day. So
that's right. It should be noted. Absolutely. Jonathan Lancer, business columnist for the Southern California News Group, which includes the OC Register. Jonathan, thank you very much for joining us live here this afternoon.
My pleasure.
Thank you very much, and stay tuned now for the 790 KBC News Blitz with Randy Wang, and I'll be back on Monday at 4 o'clock for Mottek On Money here on 790 KBC.
Are you ready for hard-hitting observations?
Reality remains reality, no matter how hard you try to ignore it.
The Ben Shapiro Show brings you all the news you need to know in America today.
Again, I'm all here for the pop culture, people dating each other for the press.
Ben breaks down the culture and never gives an inch.
Every so often, and by every so often I mean literally every 27 seconds so the producer gets fired.
The Ben Shapiro Show on YouTube or wherever you listen.